Joshua Brannon, your dream come true. We did it for you. What's up, Rachel? Happy New Year. Bits of interest. Adam Nelson, Stock Market Mike, Jay Luther, always on time. Zach Wolf, always on time. Good to see everybody. Good to see everybody. Cliff Peebles, I see you in the chat, tearing it up. Good man. Pam Hill, happy 2022. You too. You too. Thanks for coming. Hi, Roger. All right. First, what are your thoughts of the new year? I'm so excited, as you can tell, at how loud I'm shouting into a microphone, which really makes no sense. I know. I'm sorry. I love this time of year. I feel like I have a clean slate, and everyone's forgotten about all the stuff I was wrong about last year, and I get to start all over again. So anyway, this is gonna be a good show. We have a lot to get into, but before we go forward, Michael, say hello to everyone.
Hello, everyone.
How was your new year?
Awful.
Horrible, right? You don't want to get into it?
COVID-y.
All right. Where's Y charts? Put up Y charts. We're doing a lot of Y chart stuff tonight. All the charts, or most of the charts that we use in our content and here on the show, were created with Y charts. If you haven't checked them out yet for your own investment research, check out the link below us, and there is a discount for first-time registrations. Thank you, Y charts. Okay. You want to be a contrarian, Mike?
Well, it depends.
No, it's yes or no.
No.
Would you like to zig when the whole crowd zags? Isn't that what you're supposed to do as an investor?
Not really.
Way overrated, right?
Way overrated.
All right. I have identified an asset class that if you were to put your own money into it, you would be perhaps the biggest contrarian in the world. May I present to you the biggest piece of shit asset class on the planet, and I don't even think it's close. Emerging markets, local currency debt. How about that? Does that sound obscure to you?
It's not as obscure as you would think. It's it's a big asset class.
Actually, it's 25% of the entire global fixed income market. I didn't know that. I didn't know any of this, so bear with me. There's $111 trillion in fixed income globally. Everything. Developed, emerging, government, corporate. This is $30 trillion is in emerging markets, local currency denominated bonds. So this is like every bond in China, Brazil, Russia, Uruguay, right? So, okay. Let me run down this asset class for you. Put that chart up that we made. These are two Go ahead.
Where are you getting this? Where are you getting this data that you're about to pull from? I'm just curious.
Whole bunch of sources, but predominantly a fixed income shop called Ashmore.
All right, before you go into this, so what people are looking at, put that chart up one more sec. What people are looking at up top is the debt in U.S. dollars, total return. On bottom, it's the local currency. So
awful. Just awful.
And if you zoom it back, you take this chart off. If you zoom it back, I'm looking like EBND, for example.
It's awful still.
Over 10 years, up 5.7%.
Can you imagine?
With massive volatility. For example, for comparison, BND, just like the total U.S. bond index, is up 31%. I mean, this is just garbage. Just go ahead. What do you got?
All right. So that chart, we had an ETF called LEMB. This is JP Morgan's index ETF. It's iShares based on a JP Morgan index of emerging market. One of the first issues with this asset class is the index only covers like a fifth of all of the opportunity out there in these bonds. So it's already not very representative of what it's supposed to be. Then you look at returns. I was so blown away by this, Mike. The asset class over the last decade, let's use this index ETF over the last decade, is compounding at negative 0.37%. I mean, that is for fixed income in a zero interest rate world for most of that 10-year period. That is truly remarkable, no? And can you think of anything else that's been that awful?
No, this is not multiple 20% drawdowns.
Yeah, horrendous. So put that chart back up. So I'm showing a Morgan Stanley managed debt product. This one actually is not local currency, and I wanted to show people that chasm of returns there. The local currency is really what kills you. It's the adding of insult to injury. All right, chart off. So basically what's going on is not only do you own bonds that have done terribly, But then, to make matters worse, you own them denominated in the worst currencies in the world. And they're all versus the dollar. So you went basically short the dollar, which has been strengthening. The dollar hit a 16-month high last week, and I think had one of its best years ever last year, up 7% on the year versus the whole world. Versus these EM countries, it's been much even better than that. And now you're going into a rate hike cycle, which should fuck up emerging market currencies even more than it already has. So anyway, if you want to be a contrarian, this is a $30 trillion asset class. Nobody else wants it. You can buy all of it if you choose. I don't think I have the guts for this, and the yields are not even that great. What do you think these things are yielding, by the way? Take a guess.
6.
You think so?
Not even?
Dude, this LEMB product, the JP Morgan index, 3.92%. You gotta be kidding me. The only way you could seriously invest in this is, I think, if you're expecting a lot of capital appreciation because that yield's not getting it done for me.
EBND is 4.6.
Kiss my ass, 4.6, right? No way.
I'm looking for. Oh, here it is. So in JP Morgan's Guide to the Markets, I was reading this afternoon. The good news is the duration of emerging market bonds is it's not even that. It's not even way lower. It's like 5 and 6 versus like 8.5 for U.S. corporate bonds. So if interest rates rise, you're not going to get wrecked that hard. All else equal, which it never is, you probably will get wrecked harder.
Is the only way this works is if the dollar gets crowbarred and there are no rate hikes this year, but for some reason, growth in emerging markets, like GDP growth, is better than expected. Like how does this even work?
I don't know.
I'm trying to figure out a scenario where this is a good investment. I can't find one. Anyway, giant asset class on the surface looks to be completely uninvestable. If anybody has an alternative take, I would love to hear the bull case for this trash pile. Okay,
all right.
Where do you want to go next?
We're jamming 2 topics into one. I want to talk about some misreporting by the Wall Street Journal, in my opinion.
Okay, be careful.
They said, no, they should be careful. They said that 85%, yeah, I said it, 85% of active U.S. stock funds were on pace to underperform the S&P 500 this year as of November 30th, which technically is true.
Sounds bad.
Is true, but guess what? Why should small cap managers be compared to the S&P 500?
Is that what they're doing? They're comparing who said?
I said. Jeffrey Patak said.
They said it in the article that's the methodology?
85% of active U.S. stock funds. So let's throw up this next chart for comparison.
That's really stupid if that's what they're doing.
So thank you.
Who's the reporter?
Doesn't matter.
It sort of does.
All right. Well, I don't need to name the reporter.
I'm very petty. Go ahead.
So okay. For example, small. Let's scroll your eyes down to like all small. For example, only 27% of small active funds beat the S&P 500. Guess
how
what?
Could they?
Because how would they? The S&P killed small stocks, but if
they don't have Apple.
Exactly. But if you look in the middle column, 79% of them actually beat their benchmark.
That's pretty damn good, actually.
Pretty damn good. So that's why that 85% headline number is really misleading and totally nonsensical. I will say, though, the S&P 500 as a bogey for large cap managers was ludicrously difficult to beat over the last decade, especially over the last year. So large growth companies, this is interesting. I'm not sure how this happened. Large growth managers, only 13% of them beat the S&P 500. Okay, large growth. No, but large growth.
So bad though.
But here's what's bad. Large growth and the S&P actually did both about the same thing. So it's not like large growth killed. But here's what's bad.
About 30%.
Here's what's bad.
Total return.
It was like 27, 28,
okay,
whatever.
Fine.
Only 13% of large growth managers outperformed their index or their specific benchmark.
Meaning the S&P growth index?
Only 13%. The only way they could have done that was, well, I guess being underweight Tesla.
Underweight Nvidia, Tesla, Apple. You're fucked. You're done.
That's it.
Because those 3 stocks, I guess Microsoft shows up in those indices also. If you were underweight those, I don't see how you could have done it this
Toast.
year.
Let's keep moving. So the next chart is very good. This is from Jeffrey Patak. Again, adding some fantastic color. What we're showing here is going horizontally. You see the date, right? The calendar over time. The blue bars are the active U.S. stock funds versus the S&P 500. They started out the year strong. Why? Because the Russell was outperforming.
Yeah.
So the orange line is showing small stocks minus large stocks performance. And as the performance waned from small to large, so did returns from active managers, which
sort
is
of the amount of active, right? The success rate means the amount of funds in the category, right?
Yeah.
Okay. So we're all slaves to our benchmark, no matter what, like what we say we're playing against. And that's a really great example of that. Like if you're supposed to be picking small caps or even all cap, and a certain percentage of your portfolio is supposed to be small and mid, if that segment of the market starts falling materially behind the FANG names, there's nothing you could really do about it.
There's nothing you could do. So I'm sort of over this active managers underperforming. I think it's just
it's so fucking boring.
It's so boring. I think the top 10 stocks are 32% of the index. If you're
Right.
not, if you're underweight them at all, you're screwed.
Or
And
what about just like buy the index and then add some active managers that you like around it, and some years it'll be good, some it won't, and get over it.
Yeah. So
Or
yes.
don't do it.
So okay, if the S&P is up 28 and your active manager's up 25, are you like fucked?
Oh, I'm firing this guy
Who cares?
first of the year.
It's such
Childish.
a waste of mental energy. Before we go on to some ETF stuff, what do you want to throw in here?
Wait, what? I don't know what were we combining? What were we doing here?
So your performance table for asset managers.
So no, we're not really combining. I wanted to make this point that I thought was crazy, which is you're telling me basically 15% of actively managed funds were able to beat like the simplest index on the planet. Meanwhile, that doesn't show up in their stock prices of the publicly traded asset managers. They've almost never had a better year in terms of their stock performance. So it's like the investors are not really punishing them for that outperformance based on what's happening with their share. Give me that table, Big John. Well, just humor me. All the way in the right side column, 2021. So you're telling me all of these companies did not do their jobs, basically, right?
No, I'm not saying that. You're
all
saying
right,
that.
fine. But that's like, if they're not beating their benchmark and that's what people are paying them to do, then they didn't really do their jobs. In the meanwhile, affiliated managers, which is like a conglomerate of, well-known managers, had a 62% gain this year. Wow. Alliance Bernstein, 56%. T. Rowe they all beat the market is my point. The S&P went up 28. So maybe it's better, Invesco, great year. Maybe it's better rather than invest in their funds to just invest in their companies because their companies did great.
Well, Balchunas has made the case a lot over the years that these hedge funds and all of these active managers that are found to beat the benchmark, it's been tough, are still getting bigger. Because the wind is at their back. If the market goes up 31% and then 18% and then 28%, even if you lose a quarter of your assets, you're still going to come out ahead.
And it's rare for one of these companies to lose a quarter of its assets in any one year. And the reason why it's so rare is because those names I just read off, not one of them is a pure play equity manager. They all have fixed income funds. They all have asset allocation models.
And a lot of it is 401k money.
And a lot of it is captive money where the participants don't even know what an ETF is, let alone the fact that they don't have access to one. That's a good point.
Let's run through some more charts. All right, this is from
Go ahead.
Balchunas.
You're in charge.
This is all Bloomberg stuff. Vanguard ETFs took in $322 billion this year, which is totally absurd. It's $1.3 billion a day and about 60% beyond the old record. Chart off.
Chart back on. What are we saying here? What are we saying here?
Vanguard ETFs took in $1.3 billion a day, 60% beyond the old record for an issuer.
Is that $1.3 billion a day on every weekday the market was open, or just period, 7 days a week?
No. Every day the market was open.
That is fucking nuts, though, right?
Let's move to the next chart. It's the same thing. I don't understand how this is accelerating. I really don't. So what we're seeing here are the three Goliaths, iShares, Vanguard, and State Street, compared to the rest of the industry, which is, by the way, on fire. I don't understand how this keeps going higher and higher and higher and higher unabated.
Because the amount of money, period, in the market is going higher and higher, and they're maintaining market share. They seem to be accelerating their market share a little bit, but all that is the growth of the stock market and Vanguard's piece of it growing alongside of that. I don't think that's what.
Next chart. This is from James Seifert. $910 billion in total flows. These are ETFs.
That's $1 trillion.
Haven't seen a bigger relative annual flow number since we saw $140 billion in 2007 after $70 billion in 2006. So
Michael, they put $4 trillion in people's bank accounts. What? I mean, why does it have to be more complicated than that? They literally did that.
And you think all those people are buying ETFs?
No, a quarter of the money went into the market. We know this. We know this empirically. A quarter of the money. Think about our existing clients. The number that I was shocked by when we looked at all the stats at the end of the year was how much money our existing clients added to their own accounts. I was like, wait, can that be right? We raised how much from existing clients?
But that's not from stimulus checks. What are you talking about?
But it is because it's from all of the liquidity. They obviously didn't get stimulus checks into their bank accounts as low-income earners, but they got the largesse of the Fed, like reflected in their bonus they were paid at work, reflected in like the profitability of their small business that they own, whatever. Like that's where that money's coming from.
No doubt a lot of this.
So what do we do with it? We fucking throw it at Vanguard. Like iShares, direct indexing, all the stuff that we're doing, that's what's showing up there.
Cool it with the language.
If you talk to financial advisors and you ask them, like, did your existing clients who you thought you had every dollar of their money invested, did they add to their accounts? Like every advisor that I've spoken to is like, holy crap, I don't even know where this money came from.
Right.
So that's the stimulus money. It may not be direct, but even if indirect, I don't think it's mysterious.
Okay, good point.
So that's how Vanguard's able to do that.
Are you pitching stocks or what? What are we doing here?
Let's do some. Let's chop up some tickers. No, I wanted to see if I can get you to buy a stock. All right, wait, hold on, Mr. Batnick.
I'm feeling very liquid. So,
Mr. Batnick, this is Josh Brown from Ritholtz & Co. Perhaps you've heard of us.
Nope.
We're a boutique investment bank based in Midtown Manhattan. How are you this afternoon?
Good.
Great.
Wait, how did you get my number?
Oh, that's a good question. I'll get to that in just a moment. But before we get started, I want to make sure you have a pen handy because I want to give you a ticker symbol and I want to make sure that you have it written down in front of you just in case we get disconnected. Do you have that pen? Terrific. The name of the company I want to talk about is the A.O. Smith Corporation, ticker symbol AOS. Are you familiar with the company at all? Have you heard of that?
I've never heard of it.
Okay. Based in Wisconsin, been in business since the Civil War, believe it or not. One of the longest standing publicly traded names, and yet a market cap, Michael, of below $15 billion. If you were to go down to the basement right now in your home and look at the water heater, there's a 1 in 2 shot that A.O. Smith is the manufacturer. Isn't that interesting?
You had my curiosity. Now you have my attention.
Now I have your interest. Well, here's the bottom line. We are underhoused in this country. We're going to be building millions of homes. Half of those homes or more will have an A.O. Smith boiler or water heater. And 85% of this company's sales on an ongoing basis are replacements alone. Now, what if I told you in the last couple of years they've entered the India and China market and not only selling their branded water heaters, but also doing what is it called when they clean water? What is that called?
Desalination?
No, but close. Something like that.
Wait, is this water heaters as a service? Is this like a recurring
Michael,
revenue?
clean water is a substantial health risk and a serious issue in places like India and China. So I have to ask you.
Is this ESG?
I have to ask you if A.O. Smith is entering 2 of the biggest markets by population in the world with their top of the line water heaters and water cleaners. I have to believe this stock should trade substantially higher given its low valuation, high buyback, and dividend yield. Would you agree with that statement?
It's got the high dividend yield.
Yes.
Right.
About 1.3% versus a 10-year treasury at 1.6%. Plus, they bought back $400 million worth of stock last year. Okay. As they enter these high-growth markets, I have to believe you can picture the stock trading to at least $100 per share and beyond. Am I right?
Are we done?
How many shares can I put you down for?
All right, what's the deal with this?
Will I be setting this up as a joint account or an individual account? You tell me. What's easiest for you?
Why? How'd this get on your radar?
I'm trying to find stocks that I think have high prospects for this year that are paying a decent yield and buyback, have sustainable margins.
Did you find this in Barron's? Did you find this in Barron's?
No, I actually have a screen on Y charts that I use. I'm looking for stocks that are within 3% of their all-time high that pay a dividend yield. And then I end up with, like, out of S&P 500, I end up with like 30. And then I just chop through them. So I picked this one up this week, full disclosure. And I'd like to get you involved in this name.
Is this investment advice?
This is investment advice only for you, not for anyone else watching this show. I believe you should put 500 shares away. Believe me, you'll thank me in 3 years.
Can I wait for a pullback?
Michael, what's your social security number? I'm setting up the account right now. All right, let's move on. What are we doing next?
Dude, growth stocks. Holy moly. All right, before we get into like the damage, and this has been a recurring theme, let's just show this first gorgeous chart from JP Morgan. Shout out to the whole team there. So what we're showing here is the median S&P 500 price to earnings ratio. That's the green line. The gray line is the valuation dispersion, I guess based on PEs, between the 20th and 80th percentile of S&P 500 stocks. So it's
getting bigger.
The real expensive and the real cheap. And this is growing larger and larger and larger. And just eyeballing this, it appears to be at an all-time high. So I want to talk about some of the absolute smackdowns that we're seeing. We're gonna go through 3 charts, and then we could do some commentary. First chart is the IPO ETF relative to the NASDAQ 100. So I believe the IPO ETF itself is at an all-time low, but relative to the NASDAQ 100, which are, you know, the names, the big ones. This is holy moly. It's just levels of pain that you don't wish on your worst enemy. Next chart. There's two tiers.
To be clear, none of these stocks are in that S&P 500 calculation that JP Morgan ran on PE ratios. Not one of them.
Okay, good point. Okay. All right, so there's 2 levels of carnage. There's the stocks that for the most part held up well last year during some of the growth stock sell-offs. Like Shopify and Square didn't really, now it's blocked. Shopify and Square didn't really, they held up pretty well last year. Shopify got boot smacked today, down 9%.
Yeah.
So these are the stocks that are falling. You've got Snowflake, which is looking just horrendous. Shopify, Unify.
Snowflake melted.
I'm sorry. Yeah, exactly. Square and Twitter. Twitter's at a 52-week low. What a piece of garbage. These all look really, really bad. But then you've got the stocks that look really, really bad. Next chart. All right. All of these stocks are down.
Oh, thank God I don't have any of these right now.
All of these stocks are down 60% or more, and basically going out near lows. Again, needless to say, the Dow closed at an all-time high today. So we've got Zoom, we've got Opendoor, DraftKings, Zillow, Teladoc, Robinhood, and Peloton, which is down 80% from its high. Chart off. So
Peloton looks like my ass. That whole chart is a graveyard. Never put that chart up again.
Not only are these stocks crashing, but on the flip side, you've got the cyclical names kicking ass.
For the first time in a long time.
Look at ExxonMobil, like all of the energy, industrials, materials, financials, transports, home builders.
You remember that screen I just told you I run?
Yeah.
The whole thing was building supply companies, including Builders First Supply or whatever. BLDR, you ever see this stock? My goodness. Eagle Materials, Masco, which makes, I think, sheetrock or wallboard. What was the other one? Builders, whatever that's called, Builders Supply. That's a $16 billion market cap. It's tiny. And that thing has made people so much money. Anything that has to do with throwing up residential real estate is going absolutely crazy right now. So that was my whole screen.
One piece of unsolicited advice on people that are trying to pick bottoms and growth stocks, and I've done this more times than I like to care. I did this in Robinhood recently twice, is that you have to do 2 things. You have to either wait for these to stop crashing, because if you don't think they can go lower, believe me, they can go a lot lower. Wait for them to stop crashing, and if you're not willing to do that, buy small. Buy very, very small. And if you're not going to wait for them to stop crashing and you're buying today, then you need to give yourself like legitimately like at least 6 to 12 month runway, because these things can go a lot lower. So if you're good at bottom fish, very small. Do not be stupid.
I did that. I bought my first tranche of Roblox. And the idea is like I have 2 more chances to buy it.
Yes.
And scale.
Yes.
And if I take the same dollar amount and do that as the stock falls 10, 20%, whatever is a worst case scenario in my own mind, it's already way off the high. If I do that, I end up owning more shares at the lower price. And then if it turns around, hopefully it turns around, that strategy, I'll have a lower price than I would have if I just like blindly said, okay, this is where you buy it, which I almost never
averaging
do.
down in a growth stock and when they're crashing is like super sketchy. So you could do it. I've done it. I'll probably do it
I don't
again,
do it often. I don't do it often, but I
just keep it small. Just keep it small.
always keep. Okay, I think that's very good advice. Speaking of crashing stocks, well, they're not really crashing anymore. Visa and MasterCard. I want to just read to the viewers what Chamath said on his podcast, which I thought. So I think he's right. I just think he's early, but I think directionally what he's saying is going to be true. So he's basically saying you can short these companies with impunity, and if you want to pair them with a long, pair them with like a DeFi company that is going to take their place as the middleman. So if you understand why MasterCard and Visa have such a great business, they don't take any credit risk. They are earning an interchange fee. All they're doing with their rails is verifying to the seller that you're good for the money and verifying to you that the seller is reputable and going to deliver the product or service. That's all they do. And it was very important to the formation of modern financial services that somebody served. That way we don't have to pay cash for everything and carry all our money around with us. The thing is, if you start thinking about crypto as an open database where you no longer need that third party to verify everybody because it's all out in the open. Yes, this person has the money. Yes, this person has the good. And yes, we can cross these two things and everyone will have a record that it really happened. That's a very big problem for interchange. And I don't think it makes Visa and MasterCard disappear. I think it makes them harder for them to continue to justify that piece that they're taking on every transaction. And at the margin, it could dramatically slow the growth expectations that are already baked into the value of these stocks. So
I completely agree and disagree.
Well, Chamath is saying, quote, be short these companies and anybody that basically lives off of this 2 or 3% transaction tax and be long, well thought out Web3 crypto projects. Good luck on that. That are rebuilding payments infrastructure in a completely decentralized way. I sold MasterCard this year I was holding it for like 7 years. I'd done very well in the stock. I no longer think I can sleep at night with these names the way that I used to because of this threat. Is that overstated?
I think you're both right. I think that he's right-ish, but like maybe 10 years early. These things have such gigantic, I mean, are they going to be a melting ice cube? Maybe, but how long does it take for that to play out?
BlackBerry cut off its service today on the same forever. It's BlackBerry
really?
service today, which is the same day Apple hit $3 trillion in valuation.
Chef's kiss.
In 2007, not that Chamath was doing this, but when the iPhone came out, BlackBerry, I think, was the biggest company in Canada and one of the biggest technology companies in the world. And everybody you knew had a BlackBerry. And it seemed almost inconceivable if somebody were to say, in 13 years, Apple will be worth $3 trillion and BlackBerry will shut its service off. So it's not that I think he's going to be right and this is a great trade for 2022. I think that's wrong. I just think the future will sneak up on us faster than maybe is conceivable to us right now. What do you think about that?
I just want to put a pin in this for a second. Speaking of Canadian stocks, remember Shopify was like the super darling? This stock looks terrible.
Yeah. Well,
it looks so bad right now.
The joke is you never want to be the biggest stock in Canada because what ends up happening, think about the lineage. Nortel, Valiant.
Oh, wow. I forgot about that one.
Wait, the order is Nortel, BlackBerry, Valiant, Shopify. Yeah. You never want to be the biggest. You never want to be the darling of the Canadian stock market. It's a very perilous place to be.
I'd rather buy Shopify here than one of the companies down 70%. But let's throw up that chart of the market caps of these three companies. So I included American Express, which is a bit of a different beast, but whatever. So there's $1 trillion in market cap on the line.
Sick. So, wait, the Visa, Matt, we didn't put in Discover, we said?
Nice.
And
no,
we didn't put in Capital One.
Right.
Amex is still one of the largest holdings of Berkshire Hathaway. I don't think Buffett is losing sleep over blockchain because within his lifetime, it probably is not going to matter. But maybe Ted and Todd rethink that position.
Although maybe Chamath's right, and these things happen way faster than I think they're going to. But I just think that the thing is,
there's no app that your wife or my wife are going to use when they're buying clothes for the kids at the mall or whatever. That app where they interchangeably use Bitcoin to pay for something or any DeFi token or whatever. That's going to be the determinant of whether or not this is like a tomorrow thing or a 10 years from now thing. I did start in my Venmo, I just did start randomly just converting dollars into Bitcoin. I don't really know why.
I tried to do that. It said I couldn't.
What do you mean it said you couldn't? It was really easy. They sent out a text to me this weekend to do it, and I just listened and I did it. It was super easy.
I got a weird error message. I'll try and do it right now. Anyway, I think it's going to take a while for mainstream. So not yet available in your region, but I don't get it. You and I are in the same region.
Yeah. What region? What region of the town we live in were you in? Were you on the wrong side of the tracks?
Anyway, short anything with impunity is a bold statement. I don't like hearing that.
Was that his exact words? Short it with impunity, or did I say that?
Isn't that what you said? Or
I think I said it. I don't think he said it.
Okay.
All right.
Whatever.
But he's super bearish, and directionally, I feel like he could be right. But to your point, these companies are so big. And by the way, there's no reason why they couldn't figure out where they belong in the crypto ecosystem and find a way to make money from all this. They've been pretty good at that over decades, I would point out. Okay,
all right,
what do you got?
Last topic. I want to talk about some facts, some actual facts. People talking about when the Fed takes away the punch bowl, the market will stop being manipulated, and buybacks are manipulating the market, and interest rates, and all that sort of garbage. The fact of the matter is that, and obviously the government, Treasury, not necessarily the Fed.
People have to sell newsletters, Michael.
Yeah, I know.
I feel like you're being disrespectful.
Treasury had a lot to do with this. But let's throw up this first chart, and we're gonna plow through some of these. Real GDP. Guess what? All-time high. There's not. Whatever. All-time high. It is what it is. Let's look at this next chart. Josh, you and I have spoken about this. We spoke about this once or twice over the course of last year. That earnings were growing, the multiples actually contracting. So the S&P 500 last year was up 27%. The multiple actually, if it's just stayed flat, it would have been up 35%.
Yeah. Multiple contraction all year.
You see the earnings growth in the gray, you see the S&P 500 in green, and you see the multiple contracting, the price to earnings multiple, I think is what they're using, coming down. And then next chart, lastly, this is really, really, really something else. We've got the sources of earnings per share growth. And again, thank you to JP Morgan for this delicious chart. Last year, margins took a hit. Obviously, our bottom lines took a hit as the economy shut down. They came roaring back this year. Earnings per share grew 72%. Margins expanded, or margin expanding was responsible for 55% of that. Revenue growth was responsible for 17% of that. And share dilution, actually, the opposite of buybacks, took some away. But the thing that I want to point your attention to is you see that little tiny blue line or the blue bars, Josh? That's 0.3% out of 6% over the last
shrinking
20
share
years.
count was very irrelevant to right.
Yeah, so if you squint, you could see the manipulation of share buybacks. Chart off. The share buybacks are used to offset share issuance. These are not manipulating the market. I don't know that this is necessarily the evidence of, but the buyback index actually underperformed. So just get out of here with that nonsense. Enough.
Well, put up the second chart, the one from the middle, real quick. This is so good. Big John, what do you? Yeah. All right. So the market is smart. So everybody knows that the acceleration that we've been seeing in earnings is not sustainable. You're not going to have companies raise prices again to this extent. They're not going to have an excuse to, right? So the multiple shrinking by almost 8% makes sense, and the market did that Nobody put a gun to, all right, chart off. Nobody put a gun to anyone's head and said, okay, you have to pay less for a dollar of earnings starting in the second quarter of 2021. Like nobody like decrees this. This is just what investors started to do of their own volition. I wouldn't be surprised if we have another good year of earnings growth, but even more PE multiple compression this year, because we're probably going to have 2 or 3 rate hikes. So that makes sense to me too. Now, buybacks, I don't know to what extent, but buybacks should be strong this year and should be able to help offset a little bit of that. But that's very possible that we see another year of this, and it's very healthy. It tells you that people aren't just paying up. Now, that's S&P 500, and I guarantee you it doesn't look as good for the Russell 1000. And then if you start throwing all these IPOs and shit in there, it's going to look even worse. But multiple contraction, absolutely, I think we should be saluted. People are being realistic. Like I don't see any negative thing about that. What do you think?
No, I think the market is smart, and the market is getting ahead of the fact that this year is going to be harder than last year. Duh.
Yeah. Duh. Right. And it should be. Okay. Very good. Where's Duncan? Beehive, make some noise. You know the hive missed you, Duncan, while you were away.
Yeah, well, we missed all of them. You know?
Anything to report from North Carolina before we go in?
It's a lot of snow here right now where I am.
Snow.
Yeah,
that's interesting.
Wait,
what's that about?
They have internet in North Carolina?
Believe it or not, we actually have fiber here, whereas I don't have that in Brooklyn. It's not
they
even available.
They pay for that internet with emerging market bonds that the state of North Carolina issues. Okay, let's go. What do we got?
Okay, so first up, we have a question from Cam who writes, I'm 31 years old and I make $325,000 a year. I'm maxing out my HSA.
That's it. That's the whole question.
Trading bored apes? How?
He just wanted a high five.
Yeah.
I'm maxing out
next
my...
topic.
Okay, but for real, so I mean, yes, that's good job on that. But the question's one that is
Rachel likes your background. Tell us you're from North Carolina without telling us you're from North Carolina. Is that pine, sir?
That photograph. Oh, you mean the wood? I got you. The photograph's from Colorado, actually. But anyway, okay. So I'm maxing out my HSA 401k and doing a backdoor Roth, as well as saving in a brokerage account. I normally fund my 401k pre-tax, but I have a Roth option available. I know a lot of it depends on my future income when I'm at retirement age, but would you continue to fund the 401k pre-tax due to the tax bracket, or suck it up and pay taxes now for future tax-free growth?
I would tell you to listen to the Animal Spirits podcast that we did with Bill Sweet, who is my accountant, our CFO, because we get this question all the time. And I think for this person, given how much money you're making and what bracket you're in, it makes sense to do the pre-tax. Any thoughts?
Why does it make sense to do the pre-tax? Because of the tax bracket?
Because of the tax deduction.
Okay. Did Bill get more in depth in this?
Or I should say not paying the taxes on that. Of course, it was 25 minutes.
Yeah, and on Portfolio Rescue with Bill a while back with Bill and Ben, they went deeper into this. But this is a question we get all the time, so I like us addressing
the other option is you pay the taxes and then you put it into a Roth and you get all the tax-free growth.
Yes.
But nobody, again, this is like a very heated debate. It's super nerdy. Some people say you could split the difference of the backdoor that this person's doing, which this person obviously already is ahead of the game. They already won. But I think that you know what your salary is today, right? Like that's a fact. You know what tax bracket you're in today. And this person's probably, depending on what state they're in, high at the top, or close to the top, or near the top at the top.
Yeah.
Get the break today.
You're probably not going to be anywhere near that tax bracket if and when you're withdrawing these funds, like a very long time from now.
Well, if this person
is 31, earning at that rate,
if this person is 31 and makes $300,000, they might have $10 million in retirement, and God willing, we have some decent rates in the future. You might just be based off of 4% 10-year. You might be in the highest tax bracket.
Duncan, will you link to that Bill Sweet commentary on this topic in the YouTube comments?
Yeah. Okay. Yeah, we'll throw that in the description.
All right.
Okay.
Next and last.
Okay, yeah. Up next is a question especially for you, Josh. Gen X Greg asks, can I now safely discard mean reversion along with the rest of my 1980s era business school valuation models?
I mean, the minute I say that, we're in big trouble.
Well, what did we just talk about with the growth stocks?
Yeah, they're doing a very gradual, almost unnoticeable mean reversion, though, aren't they?
Unnoticeable. They just reverted hard. Very mean.
Yeah, very mean. So I guess the problem is that the mean part changes. And Michael has made this point so much more eloquently in his blog posts over the years than I can right now. But the mean seems to be traveling higher of its own volition over time. So the mean is not static. And that is what's tripped people up, is that companies are just better at being companies in 2022 than they were in 82 or 62. So like that, you have to think about a mean not being a static number, like, oh, let's just take the average valuation on whatever metric, book to market, price earnings, whatever, and just like act like that's not traveling higher. That's traveling higher because we learn things, and business schools adapt to new reality, and executives get better at their job versus what their dad's generation was. So it's not that can go on forever, but why would we ever have profit margins like the 1970s again? Like, what would be the thing that would happen that would make that happen? It's hard to picture. So that's why that's not a useful way to invest.
People like look at a data set of the last 100 years and be like, oh, well, here's the average of the last 100 years. Who gives a shit? To Josh's point, things were so much different in the 50s, 60s, 70s than they are today. So if you actually track the average over time, like what was the average in the 40s, like from 1920 to the 40s to the 50s?
Exponential, weight that exponentially.
Yeah.
Overweight recent history.
Or
throw it out.
over time. just over time, it's been rising for the last 40 years.
What did you say in that CAPE ratio piece that research associates quoted you? Research affiliates quoted you.
I spoke about this with Ben on the podcast tomorrow. They tried dunking on me, and I dunked back. I said basically that like we are comparing different games. It's like comparing Russell Westbrook to Oscar Robertson. They're both playing basketball, but it is the rules are different. The players are different. The game is different. There's still basketball, but everything is completely changed. So
that home run hitters in the last 25 years versus home run hitters in the 1950s and 60s. It's a joke.
It's a joke.
It makes no sense at all. Why are we saying that one should conform to what the other, used to do? So there's a lot of different ways we could explain this. I don't think you throw it out. Maybe you keep it in the back of your mind. But should you invest based on 50 years ago? I don't think it's wise. It certainly hasn't been.
Well, hold on. Last thing. One of GMO's big cases on markets and valuations and forward returns has been mean reversion, particularly in profit margins, which haven't mean reverted because companies are so much better at making so much money today than they've ever been in history, ever.
Peak profit margins
for 2012.
For 10 years now. I think we're gonna have to find a new way to describe them. That adjective that they're peaking is not apparently is not helping anyone. So okay, we're gonna wrap this up. We appreciate everybody who came out for the live version. Make sure that you're listening to Animal Spirits every Monday, every Wednesday, the podcast, and the video itself, which comes out on what day does Animal Spirits video come out? Wednesday night?
Wednesday or Thursday.
Wednesday or Thursday. Okay. And another all-new episode of The Compound and Friends coming to a podcast service near you Friday morning. And the video will be posted right here on youtube.com/The Compound RWM. Make sure you subscribe to the channel. Make sure you like this video for the algo. And we will see you guys next Tuesday night.